you're in your 40s or 50s and you just found out about dividend investing, and your first thought was probably, I waited too long. The people making real money from dividends started in their 20s. I missed it. I'm going to show you exactly why that belief is costing you money right now. This video is about one thing: how to build a dividend income stream that can replace or supplement your salary, even if you're starting today in your 40s or 50s, with whatever you have available. Not a fantasy portfolio. Real numbers. 2026 math. Most people think dividend investing is a slow game that rewards patience over decades. And for some strategies, that's true. But there's a version of dividend investing specifically built for people who need results faster. And almost nobody talks about it because the finance world is obsessed with 25-year-olds maxing out Roth IRAs. I've spent years breaking down income investing strategies, running the actual numbers, and filtering out the noise. And what I found completely changed how I think about late start dividend portfolios. Here's what we're covering. First, I'm going to show you the single most powerful reinvestment move late starters almost always skip. Then I'll show you the exact types of assets that generate the most income per dollar invested in 2026. And finally, I'll show you how to run your own realistic retirement math so you know exactly what number you're building toward. Let's go. Most people who start dividend investing in their 40s or 50s make one critical mistake right out of the gate. They chase yield. They see a stock paying 10, 11, 12% dividends and they think, finally, a shortcut. I'll just load up on high yield and make up for lost time. And look, I get it. The logic makes sense on the surface. Higher yield equals more income faster. But here's what actually happens. Many of those ultra high yield stocks are paying out more than they earn. That's called an unsustainable payout ratio. And when the company eventually cuts that dividend, and many of them do, you lose the income and your share price drops at the same time. Double hit. Late starters cannot afford that. You don't have 10 years to recover from a bad bet. But, and this is where it gets interesting, there's a middle ground that almost nobody talks about. It's called the yield growth sweet spot, and it's the single most important concept for anyone starting in their 40s or 50s. Here's what it means. Instead of chasing 12% yields that are likely to collapse, you target stocks and ETFs yielding between 4 and 8%, with consistent dividend growth of 5 to 10% per year. That combination does something almost magical. Let me give you a simple example. You invest in a stock paying 6% today. It grows its dividend by 7% every year. In 10 years, your yield on your original investment isn't 6% anymore. It's over 11%. You built a high yield without ever touching a risky stock. That's called yield on cost. And it's the secret weapon of every serious dividend investor who started late. Now here's why this matters in the bigger picture. When you're 25, you have time to buy low-yield, high-growth stocks and wait 30 years for the yield to compound. When you're 45 or 52, you don't have 30 years. You need yield now and growth. The yield growth sweet spot gives you both. It's not a compromise. It's actually the smarter strategy. That's important. But if you don't also understand the reinvestment structure we're about to cover, you're leaving a massive amount of money on the table. Let's talk about the move that most late starters completely skip. It's called a DRIP, a dividend reinvestment plan. And I know you've probably heard of it, but I'm not just talking about turning on the DRIP button in your brokerage account. I'm talking about a specific phase-based DRIP strategy that changes everything for someone in their 40s or 50s. Here's the concept. When you're in the accumulation phase, meaning you're still working and don't need the dividend income yet, you reinvest every single dollar of dividends back into buying more shares. Every quarter, your dividend payment buys more shares. Those shares pay more dividends. Those dividends buy more shares. It's a compounding loop. Now here's where the phase-based part comes in. Most people either reinvest everything or take everything as cash. But the smart late starter move is to set a specific date. Let's say 3 years from now, or when you hit a target portfolio value, when you flip the switch and stop reinvesting. At that point, you start taking the dividends as actual income. This is called the accumulate then activate strategy. Simple name, powerful concept. Why does this matter? Because the math on reinvestment is violent in the best way. Let's say you have $150,000 invested in a dividend portfolio averaging 6% yield. That's $9,000 a year in dividends, or $750 a month. If you spend that $750 every month in 10 years, you still have roughly $150,000 invested. But if you reinvest that $750 every month for 10 years, and the portfolio grows at even a modest rate, you're looking at a portfolio closer to $280,000 to $300,000. That's nearly double. And now when you flip the switch and start taking income, you're not pulling $750 a month. You're pulling $1,400 to $1,500 a month from the same 6% yield. That's the power of DREAP in a compressed time frame. You don't need 30 years. You need discipline for 5 to 10 years. Therefore, the question isn't whether to use DRIP, it's how long you can afford to keep it running before you need the income. And that's your personal math to run. But even 3 to 5 years of full reinvestment can dramatically change your outcome. That's important. But if you don't know which specific assets to actually put this strategy into, none of this math works. Let's fix that, okay? Here's the part most people came for. What do you actually buy in 2026 if you're starting in your 40s or 50s and want real dividend income? I'm going to walk you through 3 categories. Each one plays a different role in your portfolio, and I'll tell you exactly why each one belongs here. The first category is dividend ETFs. If you're newer to investing or you want diversification without picking individual stocks, ETFs are your foundation. In 2026, there are several high-quality dividend ETFs that hit that yield growth sweet spot we talked about. Look at funds focused on dividend growth, ETFs that specifically hold companies with long track records of raising their dividends every single year. Some of these have 25, 30, even 50-year streaks of consecutive dividend increases. These are called dividend aristocrats and dividend kings. There are ETFs built entirely around these companies. The yields on these funds might be 2 to 4%, which sounds low, but the dividend growth rate is 6 to 10% annually. Remember the yield on cost math we ran earlier. These are the engines you let run in the background. Then you have higher yield ETFs, funds focused on covered calls, preferred shares, or high income strategies. Some of these yield 6, 7, even 8% right now. These are your income accelerators. They generate more cash today but typically grow more slowly. You use these to hit your income targets faster while your growth-focused ETFs build long-term. The key is balance. Don't go all in on 8% yield ETFs. Don't go all in on 2% growth ETFs. A blend of both is how you build a portfolio that works in year 3 and year 15. But the second category is where late starters often find the most powerful opportunities, and it's something most people overlook entirely. The second category is business development companies, or BDCs. Stay with me here because this one is worth understanding. BDCs are companies that lend money to small and mid-sized businesses. They're required by law to distribute at least 90% of their taxable income to shareholders as dividends. That legal requirement is what creates those fat yields, often 8 to 11% from quality BDCs. Now I know what you're thinking. You just told me to avoid high yields. What's different here? Great question. The difference is structure. BDCs are regulated investment companies with transparent portfolios. You can look at exactly what they're lending to, what the default rates are, and whether the dividend is covered by their net investment income. A BDC with a dividend coverage ratio above 1.0, meaning they're earning more than they're paying out, is a very different animal than a random stock paying 12% because its price crashed. Quality BDCs have paid consistent high dividends through multiple economic cycles. They're not a secret. They're just not talked about enough in mainstream finance content because they're not exciting, they don't go viral, but they pay you every quarter, reliably, at yields that make your dividend math work much faster. Therefore, BDCs belong in a late starter portfolio as an income accelerator, not as a gamble. Do your homework on dividend coverage ratios, look at the portfolio quality, and size your position appropriately. Don't put 80% of your money here, but 15 to 25% in a quality BDC or two can dramatically move your income number. That's important, but the third category is probably the one you're most familiar with, and also the one most people get wrong. The third category is individual dividend stocks, specifically what I call the core 4 sectors for dividend investors: utilities, consumer staples, healthcare, and financials. Here's why these 4 sectors specifically. Utilities pay consistent dividends because people always need electricity and water. Consumer staples companies sell things people buy regardless of the economy: food, cleaning products, personal care. Healthcare demand doesn't stop in a recession. And financials, specifically banks and insurance companies, have long histories of dividend payments with strong regulatory oversight. These aren't glamorous. You're not going to brag at a party about owning a utility company. But these sectors have produced some of the most reliable dividend income streams in market history. And in 2026, with interest rates where they are, many of these stocks are trading at valuations that make their yields genuinely attractive. The goal with individual stocks isn't to pick 10 obscure names and hope. It's to own 8 to 12 well-researched positions across these 4 sectors that give you diversification without complexity. You know what you own. You know why it pays. You know what to watch for. Now let's run the actual 2026 math, because this is where reality either confirms or destroys the plan. I want to walk through 3 different starting scenarios, because not everyone watching this has the same amount to work with, and I want you to see that the math works at multiple levels. Scenario 1, you're starting with $50,000. $50,000 in a blended dividend portfolio averaging 6% yield generates $3,000 a year, or $250 a month in dividends. That's not retirement money yet. But here's what happens when you reinvest and add to it. If you reinvest all dividends and add $500 a month from your income, which is very doable for most working people in their 40s and 50s, and the portfolio grows at 7% annually, in 10 years, you're looking at roughly $175,000 to $190,000. At 6% yield, that's $10,500 to $11,400 a year in dividend income. About $900 a month. That's a meaningful income supplement. It's not full retirement, but it's a car payment, a utility bill, a grocery budget, every single month without touching the principal. Scenario 2. You're starting with $150,000. Same strategy. Reinvest dividends. Add $1,000 a month, 7% annual growth, 10 years. You're looking at a portfolio in the range of $450,000 to $480,000. At 6% yield, that's $27,000 to $29,000 a year. Over $2,300 a month in dividend income. Combined with Social Security or a part-time income, that is a genuinely livable retirement supplement for many people in lower cost of living areas, or a powerful financial cushion anywhere. Scenario 3. You're starting with $300,000, same inputs, 10 years of reinvestment and modest contributions. Portfolio range, $800,000 to $850,000. At 6% yield, $48,000 to $51,000 a year. That's $4,000 a month in dividends. For many people, that is retirement. Full stop. Now here's the thing I want you to notice about all three scenarios. The math works, not because of magic, not because I cherry-picked unrealistic numbers. 6% blended yield is achievable with the asset mix we talked about. 7% annual portfolio growth is conservative by historical standards, and the contribution amounts I used are realistic for working adults in their peak earning years. Therefore, the question isn't whether dividend investing works for late starters. It does. The question is, what's your number, what's your timeline, and what are you willing to put in? Let me give you one more concept before we wrap up, because I don't want you to just know the theory. I want you to have a framework you can actually use tomorrow. I call it the Dividend Freedom Number. Here's how you calculate yours. Take your monthly expenses or your target monthly income in retirement and multiply by 200. That's your portfolio target. So if you need $3,000 a month to live comfortably, your Dividend Freedom Number is $600,000. Because $600,000 at 6% yield generates $36,000 a year, or $3,000 a month. If you need $4,500 a month, your number is $900,000. If you'd be comfortable with $2,000 a month as a supplement to Social Security or a pension, your number is $400,000. This gives you a specific target, not a vague, I want to be rich someday goal. A real number you can reverse engineer into monthly contributions and a timeline. Write your number down, right now, seriously. Because the difference between people who build dividend income and people who just watch videos about it is that one group has a number and the other group has a feeling. Now, before I wrap this up, I want to ask you something. What's your current situation? Are you just getting started? Do you already have a dividend portfolio and you're trying to optimize it? Are you trying to figure out whether to focus on growth or income right now? Drop it in the comments. I read every single one and I build future videos based on what you're actually dealing with. The more specific you are, the more useful your comment is. Not just for me, but for everyone else watching who's probably in the same spot. And if this video helped you see dividend investing differently, subscribe. Because I cover this stuff every week. Specific strategies, real numbers, updated for what's actually happening in the market. Not generic advice, practical stuff you can act on. There's also a video I made specifically about the best dividend ETFs for income-focused investors right now. I'll link it at the end of this video. If you like this one, that one goes even deeper on the ETF side. Watch it next. Let me bring this home. Here's what we covered. The yield growth sweet spot, targeting 4 to 8% yields with consistent dividend growth, is the right strategy for late starters. Not ultra-high yield, not low-yield growth stocks. The middle path that gives you income now and more income later. The accumulate then activate drip strategy compresses your timeline dramatically. Even 5 years of full reinvestment can nearly double your eventual income stream. The phase-based approach, reinvest now, flip the switch later, is how you engineer your retirement date instead of hoping for one. And the asset mix matters. Dividend growth ETFs as your engine. Higher yield ETFs and quality BDCs as your income accelerators, core 4 sector stocks as your stable foundation. And your dividend freedom number is the target that makes all of this real. Here's what I want you to walk away believing. Starting in your 40s or 50s is not a disadvantage dressed up as a challenge. It's actually a unique advantage. You have income, you have clarity about what you actually want your life to look like. You have urgency, which most 25-year-olds don't have. And you have strategies, the ones we just covered, specifically optimized for your timeline. The people who told you it was too late, they were using the wrong math. Now you have the right math. Go build something.